you've got no path for anybody figured out. You don't know who you should be selling to. You don't know what message to use. You don't know what price points to sell. There's so many unknown factors in this that are not figured out. And by the time you've finished here with this, figuring out this process, we're going to have a very well-defined growth motion, growth process that we go through, a series of steps that we go through.
Welcome to The Visionary Entrepreneur. My name is Dane Dunlap.
And I'm Nicholas Genovese.
This is a podcast where we interview entrepreneurs about their story and visions for the future. We're here to create a space to network and to learn from each other's experiences. What's up, guys? Welcome back to another episode. This is actually part 2 of David Skok. Part 1 was Visions of the Future, and if you haven't seen that, go check that out. Seriously, a great episode. Today he talks about the 9 steps on how to scale a Saas business. That is software as a service or subscription-based companies. David Skok has started 4 different companies, 3 of which have gone public. He sits on the board of directors of HubSpot, which is a big public tech company. He is the general partner of Matrix Partners, which is a really large VC firm. And he has the number 2 website in the world for entrepreneurs rated by Forbes. And the website's actually called forentrepreneurs.com. So go check that out. He actually has slides for us today. So if you're watching on YouTube, great. And if you're watching on audio only, you can go check that out on YouTube, or we'll post the slides for you as well. So guys, hope you enjoy this episode. Lots of technical stuff and hope you enjoy it. Yeah. So today what we wanted to talk about is there's traditionally 2 steps of people see kind of how entrepreneurship goes, which is the product market fit and then the scale to growth. But you talk a lot about this middle step, which is the finding a repeatable and scalable growth model. And that's something that we found really interesting. So we just wanted you to kind of talk about that. What is that?
Yeah, so I think it's worth pointing out that in the early days of startups, there was this very good book and set of presentations done called The Lean Startup. And they focused very heavily on this idea of product market fit. So that got out there in a major way. And I think a lot of people thought, well, if I've got product market fit, everything should just start selling, right? And if you're in a consumer business, that's really potentially true. But if you're in a B2B business, it's no longer true. And what you find is that if you have product market fit and you start hiring a whole bunch of salespeople, you're just going to burn a lot of cash and thrash through that money and not achieve the results that you want. And so I wish I'd known this when I was starting my companies, but there's really a series of steps that you want to go through. And I've broken them down. What I might do here, just to sort of help make this easier to follow, is share my screen. I'm just going to see if I can find the right place here to get into this.
I actually just finished reading The Lean Startup. I watched a lot of your stuff and read a lot of your blog. And so I ended up just finished The Lean Startup. It was a great book.
Yeah. Excellent. I'm glad you read it. I think it's very, very good indeed. I mean, I really approve of pretty much every idea and concept in them. So this is really effectively like the Lean Startup for the next phase that comes along. And if I can here, let me just try and share my screen. And so what I've discovered is that if you try to skip steps in the steps that I've shown here, you end up in significant trouble. So for example, let's say that you hired a whole bunch of salespeople. What you quickly discover is unless you hand those salespeople a well-defined playbook, they really don't know how to do their job at all well. A traditional salesperson is not somebody who is hired on the basis that you want them to make a lot of changes to your sales motion, because once you've worked out a very sophisticated and carefully thought through sales motion, the last thing you want a salesperson doing is playing with that and modifying it and changing it, because you've worked to prove it. So we've got to figure out what is this motion that's going to work. And one of the ways of thinking about this thing is that at the beginning, you have this jungle. In fact, I've got kind of a fun slide in here that sort of represents what it looks like. You've got no path for anybody figured out. You don't know who you should be selling to. You don't know what message to use. You don't know what price points to sell. There's so many unknown factors in this that are not figured out. And by the time you've finished here with this, figuring out this process, we're going to have a very well-defined growth motion, growth process that we go through, a series of steps that we go through that we want and can now hire ordinary salespeople to follow to get through this year. So what I've figured out here is that the best people to do the early sales are the founders. Typically, they are not only able to sell extremely well because they're passionate about what they're building and they have a good feeling why they built it. Secondly, they're also able to change things on the fly. If they run into a problem where the product isn't right, they can quickly test a new idea or a new variation of the product or a new message, which is harder for another type of person to do.
Right.
But if you are a founder who's really very shy and very uncomfortable in any selling role, there is a special kind of a salesperson that you can bring into this. And I call that person a pathfinder trailblazer sales rep. So this is not your ordinary sales rep here. This is a special individual who's generally a lot like a founder, who's able to take a very unknown situation and go into a whole bunch of different tests and experiments and try out different things to see what they can get that's actually going to resonate to get that first sale to happen. Mm-hmm. And all of this process that we're talking about here is the very first step. I call this finding the repeatable sales motion before we try to scale it and before we try to figure out other things like can we make it profitable as well. Mm-hmm. So these Pathfinder Trailblazer salespeople are, there are not very many of them around. And what's interesting about them is that once they've figured out the motion, they get bored if you ask them to keep doing it over and over again. So you want to try to keep these people, but maybe use them for things like opening up a new product line or something like that.
So these people can take the message and run with it, basically. They don't just need a script and stick to it. They can kind of work on their own and really sell the product kind of like a founder.
Yes, exactly. And there are some tricky questions that you have to figure out here. So if I can, what we're trying to learn here in this process is which target market. So if you take most products that I work with, they can actually be to different industries, and they can fit even inside of a single industry or use cases. And that's a problem because it turns out that for each different use case, the customer is going to want slightly different things in the product. So it might need to integrate with different products to really make it work well, or it might need to produce a report of a specific kind of use case. So my advice is, and you'll hear this from every person advising founders, is you need to focus. If you don't focus, what will happen is your product team will get pulled in too many directions. And it's a very small product team in the early days, and it'll never be able to meet all of the needs of these different markets that you're trying to go after. And it seems like a very easy and obvious thing to say, but it's a real struggle for founders because somebody will walk in from a different industry to the one that they're originally thinking that they should focus on, threaten them with a big $1 million order, and all of a sudden focus goes right out the window and they start chasing this different thing. And I think it's extremely important that you recognize that focus actually means saying no to things that are highly appealing. Mm-hmm. So that's one of the first steps in this here. Then you've also got to select a single use case, even after you've figured out which vertical you're going to go after. So in the very early days, you may not have the luxury of enough data to choose one. So you may just say, okay, we're going to run like 5 experiments here based on our best assessment of who we think could be potential candidates here. And we're going to score them. And I'll find a particular thing here that shows you how I think you might score these.
That's important to do those experiments because you might think that a target market's going to be interested in your product, but in reality, they're really not. And if you don't test for that, then, you could be in a bad position.
Exactly right. Yeah. Very, very right observation. Yeah. So, I gave you some thoughts here. So you might put down some ideas on which possible target markets you might want to go after. And here's a possibility on how to score them. So TAM is total available market. So you definitely want to chase big markets, not small markets. Then you want to you check what is their pain level? How seriously are they willing to actually make a decision, prioritize purchasing something? And do they actually have the ability to pay? So for example, here's I've never wanted to sell to healthcare because I find that healthcare, even though they have a ton of pain, there's a huge problem that the people who have the pain are not able to pay. The money actually sits in the insurance companies. So it's a very bad market to go after, in my opinion, unless you're selling to maybe some segment of it that doesn't have that problem. And then you might also look, we've got this product today, but to really fit this use case, we're going to have to do a fair amount of work. So you might want to pick the one that's got the lowest amount of work, the highest pain, and the biggest size of market. And that's is an obvious way of figuring out which one to pick. So you run a bunch of experiments to figure that out. And once you've got that, then you've got to start to think about messaging. And it turns out that with messaging, it's not an easy thing. Again, one of the problems that we find is that founders tend to be often very, very much in love with their product and in love with the clever features that they've built. So what they want to do is walk into a customer and describe this fantastic AI data sorting or data analysis technique they've come up with. And what you've got to recognize here is that customers don't care about features or technology. They have a problem and they're interested in solving that problem. I always love this story. It's actually an imaginary story, but imagine you've gone to the Black & Decker annual employee meeting and the CEO stands up in front of the audience there and he says, I've got good news and I've got bad news. The good news is that our drill sales are up. So we've had a great year. But the bad news is that we're not giving our customers what they really want. Our customers want to buy holes. If they could find a packet of holes on the shelf and just be able to go and stick those holes onto their walls, they'd be much happier than buying this drill and the drill bit. So I put that up there for a couple of reasons. I think one of them is it's very important to really switch your mindset around and put yourself in the customer's shoes and start understanding how do they think about why they have a problem and how they think about the words that they would use to describe that problem and the solution they want. Because they're not going to use AI, this, or database with speeds and feeds. And so I see a lot of startups really struggling with getting the messaging right to really detail. And that's another reason why you have to pick a use case, because the pain for use case 1 is totally different, and therefore the messaging is different than it would be for use case 2. And the more tightly focused your website can be around, let's say, surfing versus tennis, to put it in language that you guys both relate to very well, you understand that I wouldn't use the same language to describe what you would do for a surfer than what you would do for a tennis player. It's two totally different things, even though the product might be identical. So that's one of the things that we're trying to describe and sort out there. So at the end of all of this, what you really are looking for is a couple of customers, or really probably 5 to 10 customers that the founders and possibly founders plus one of these trailblazer sales reps have been successfully able to sell to. And you think you've got a repeatable message, price point, same use case, same way of working that you could now describe to an ordinary salesperson. And now you're into the second phase, the second step. And you remember I talked about these different steps here. So let me just bring up the steps here so that we can kind of re-look at that. So we're looking at what I call a 9-step process here. And we've just finished step 4, where we've found a repeatable sales motion. And we're now going to try and jump into step 5. And in this step here, we want to test and see if we can get an ordinary salesperson to sell. And now the whole thing that we're going to do changes. Instead of being founders who are on the phone, going to meetings, we actually need to stop doing that completely. And we now need to start focusing on training the salesperson that we've brought in, making sure we've got good training materials for them, and observing them fail in a sales situation, and not jumping in and trying to rescue the sales situation, because that's not useful. I mean, you're not really at this moment in time, making another sale is not the big deal that's going to advance your company. Right. What is going to advance your company is coming up with a process that can be followed by other people, as opposed to you keep doing it, because you're not scalable enough to create a scalable process yet. So as a founder, you've got to resist the temptation to do what you were doing in the prior step, and you've got to focus all your energy on documenting and teaching and transferring your knowledge and checking that it works with ordinary salespeople. And you have typically 2 salespeople to give you a little bit of insurance that if you're bad high, you've got some insurance to check that. And if you can make them productive, now you've got really good evidence that you've got a scalable process, and you can make out hiring a second 2 salespeople, so long as you've got enough lead generation to support those 2 salespeople. There's no point in hiring them if there's not enough lead flow coming in for them.
David, could I ask you something? I think I heard you say that some people make the mistake of not hiring their salespeople fast enough. Is that true?
Yes. Now when we're talking about that, we've switched past step 9 here.
Okay.
So you've jumped ahead to the next sort of level
Got
of
it.
this thing.
I wasn't sure if that was step 5. Sorry.
Yeah. No, it's a really good question, and it's exactly the kind of thing that I think people go wrong on, particularly with inexperienced board members. And it's very common for me to be in a board member in a board situation and hear people who haven't recognized these different elements and steps here, and they will say, "Boy, we just raised $10 million. Let's hire more salespeople. That's why we're not doing as well as we should do." And there couldn't be worse advice, because if you're trying to figure out this repeatable model and you're doing it with 5 salespeople, it's going to slow you down dramatically, because every experiment you're going to have to try to teach to 5 people, and too much data gathering with each one. It's just a tremendous waste of money and time there. So the moment where you've got the thing repeatable, scalable, and profitable, that's a crucial moment. That's like this breakthrough moment where the company again just transforms completely. So one of the ways of thinking about this here is that when you are in this, I just want to get to the right slide here for this. Hold on a second. We see a common mistake here is when you get to the very end of this process and you start being ready to scale, that you don't make the switch, because before you've got to that point, you don't want to be spending money. The reason why you don't want to be spending money is pretty simple, because we've figured out that it's not predictable how long it will take you to get to product market fit or to get to a repeatable, scalable, and profitable growth model. So, a lot of people will create a business plan thinking that their plan is reality, but it's not reality at all. And there's no basis for assuming that it will work out in 4 months or 3 months or something like that. This is series experiments that you have no idea which ones will work and when it will work at all. So in that early phase there, you want to lower your cash burn as much as possible. But have got a repeatable, scalable model, you do need to switch the whole mentality of the company around and now hit the gas and start scaling the business. And that means that you need to hire salespeople. And one of the reasons why you need to hire salespeople, actually I can find another slide that'll show you this really nicely, I think, is that when you have this model here, you're going to find that growth is capped because each salesperson has a certain number of deals that they can handle only. And once they're full of, let's say they can handle 10 things that they're working on any moment in time. If you give them 20, you're not going to get 20 deals closed. You're going to have 2 people to close 20 deals, 3 salespeople to close 30 deals. So I've made this mistake, and I've seen this made in lots of companies that were in this growth phase here, is that you stop hiring. And what you need to recognize is that your math behind your bookings, if you're sales driven, is it's actually equal to how many salespeople you have multiplied by the productivity that you get per rep there. So in that particular situation, not hiring enough is going to restrict the amount of bookings you have. But it's also important to recognize that you've got to be able to feed those salespeople with leads. Otherwise, you're going to have unproductive reps if you can't give them the amount of leads that are needed to support them.
Right. Once you have the formula and they've capped out, they're not going to improve their sales formula anymore, but you need to scale your business with the number of salespeople you're hiring, or else you're going to be capped out.
Yes. And typically speaking, I think that the factor that really causes your growth rate to slow down is actually being able to feed to salespeople enough leads there. I'm trying to see if I have the right, yeah, here we go. So most typically, not being able to create enough lead flow is the biggest stalling point that stops people from really growing their business as fast as they would like to grow it. So this is a huge challenge and a very common one that I work on with portfolio companies to try to help them solve that.
That's awesome.
So
I think. Sorry, go ahead.
If it's useful, if it's useful for you, one of the things that I really like about business is that it's actually quite simple. So I'm going to switch from sharing this screen here. Actually, this will do. I think this is fine. The simple thing about running a business is that you want to find, if you can, a common set of objectives for every one of your management team to be aligned around. And a lot of people get that wrong. They have, one group, the marketing group will be working on one thing, the product group will be working on a different thing, the sales group working on something different. And that's not what I find makes for a great company. So one of the most powerful things is if you conceive of the company, the whole company, as being a funnel, and you align everybody around the notion that if we can get this funnel working well, we will have a very successful business. And in SaaS, it's important to recognize that the funnel has not just the top of funnel where you get the original first customer, but it's also got the back end of the funnel, which is not shown on this diagram here. But it's super crucial if you have a recurring revenue model that you're able to retain your customers and not have them churn. Because the whole business model falls apart completely if you don't have the customers sticking around. And the longer you can make them stick around, the more profitable your company is. We might talk about that later on when we talk about CAC and LTV. But why I think this is so crucial is that if you study lead flow, initially most people think lead flow is the product or the job of the marketing person. They say, well, marketing, you go off and worry about lead flow. Well, it turns out, to my mind, the worst thing that has happened is the siloing of these job functions: marketing, sales, product, and customer success. And I strongly recommend that you form a growth team that has the best people from those 4 disciplines together with the founders and the CEO, who are all focused on this funnel. And what you will quickly discover is that actually things like the product people can have a bigger impact on lead flow. So a great example of this, are you guys at all familiar with HubSpot? If you come across them,
Yes.
it's one of the startups.
Yes.
Yeah, it was a SaaS company that I was originally an early investor in that's now a very successful public company. So they came up with a brilliant idea for generating lead flow. They figured out that one of the problems that every customer has is a badly optimized website for search engine optimization. So they weren't ranking very high in Google because the site was poorly set up. So they came up with something called Website Grader, and it was a free tool where all you had to do is go along and put in your URL for your company, and it would crank out this incredibly good report that showed you everything that was wrong with your website, and it would give you a score, and you get typically, say, 55 out of 100 in the score. And it turns out that there's 2 clever things about that. Well, actually, several clever things. Number one, it was a free tool, so it virally spread because everybody wanted to know this information. Number 2, because it was so beautifully structured and really clever in how it analyzed things, you immediately said, boy, these HubSpot guys really know what they're doing. They're experts, so I can trust them. I want to get advice from them. And then it did something else that was very clever. The score, 55 out of 100. What do you guys do when you get a bad score, like a C grade? You're unhappy, right?
To improve it, right?
Yeah, you want to improve it. So that acts as a trigger. And I talk a lot about triggers when you hear me talking about buyers and buyer journey, which we'll talk about in a second. But the trigger is powerful because it turns somebody who was just maybe not interested in actually pursuing a purchasing cycle into possibly somebody who realizes, oh my God, I need to fix that score. I need to buy something, or not necessarily ready to buy, but it's certainly ready to try to fix the problem because it makes them aware of pain that they maybe didn't even think they had.
Right.
So it's very clever in that regard. And then it automatically has you click a button at the bottom, which says, if you want to learn more, and then HubSpot will talk to you about
how we can help you.
Yeah, exactly.
Right. And so if I understand correctly, traditionally, a lot of people think that the marketing department is in charge with getting the traffic, and the people are like, oh, well, there's not enough traffic. But from what I understand is you can actually make your conversion rate higher by making your product better and providing value to the customer right away, rather than just, oh, let's get more traffic. That'll lead to more sales. But at the end of the day, if you have a higher conversion, then you can scale better.
Almost, yeah, you almost got it right. But in this case, it wasn't their main product that they made better. They actually invented a whole new product that was off to the side of their main product, and they did it just purely as a lead gen mechanism.
Got it.
So it's sort of recognizing that marketing is kind of limited in what they can do. They can write brochures, they can create ads, but product people can create true value. They can create products that actually And if you can come up with free products, sometimes it could be your own product that's free up to a certain level, and you switch from free, so freemium type of a model.
Right.
But sometimes it can be something which is completely separate to your main product, which is just a free thing that you do that helps people to find you and creates a step in that lead gen process for you.
We wanted to talk to you about metrics. So traditionally, we use GAAP metrics, especially in our Masters of Finance. We use things like growth and profit and multiples and whatnot. But in your blog, we found out that especially in Saas, you use different metrics. And why do we need those specific metrics in Saas?
It's a great question. And again, if you're okay with me doing this, I'd like to use some slides to help illustrate the...
Yeah, absolutely. The slides were awesome.
Great. So the real question you asked here is what's different about SaaS, recurring revenue business models, and the traditional GAAP metrics that you guys are used to working with? Well, the point-in-time snapshot that GAAP represents does not take into consideration the fact that when you sign up a customer, they're actually going to produce lots and lots of revenue for you over time. And that has very high value. So let's look at why that is the case here. So the thing that happens with a recurring revenue deal or a SaaS deal is that you will typically spend a lot of money in sales and marketing to acquire that customer. And you spend that money up front, but you don't get it back quickly. You only get it back in a small series of payments. Mm-hmm. And on average, it turns out that it takes 20 months. I've looked at a bunch of public companies, and if you look at all the public companies that are in the SaaS space, the average is it takes them 20 months to get back how much money they spent to acquire that customer. Wow. So what that leads to is a significant negative cash flow period. Here right now I'm showing it as 12 months, but imagine if it's 20 months, it's much worse. So you've spent money to acquire them, negative cash flow. And if somebody were to take a GAAP snapshot of your business, particularly at say month 2, you're going to look like a very unprofitable business, but they're not going to recognize that if your average customer sticks around for say 60 months, you really are running a very profitable business. It's just going to take a while for that profit to appear there. So we need a different way for looking at this. So I'm just going to show you very quickly what happens if you add multiple customers. This is the cumulative cash flow. What did we do here? A slow increase in the number of customers every month, and I've forgotten how many customers I was adding. But basically what happens is you get a cash flow trough in every recurring revenue business because of this nasty problem where you have to spend money. And the other that happens with this is that the faster you grow your business, the deeper that cash flow trough is. So if you're doing really well and you're a highly successful SaaS business, you're going to have bigger losses. Yeah. Mm-hmm. And so a lot of people who are traditional stock analysts really have a hard time understanding why some of these SaaS companies are worth so much money. Shopify is worth 100 billion at this point in time. Zoom is worth 50 billion. These companies are worth way, way, way more than any GAAP metric could possibly leverage. And the reason why is because if you understand how the SaaS metrics work, you have a way of recognizing that they will be extremely profitable at a certain point in time once they flip to the profit side of this equation here. And you can see at the far end of this, where I'm showing with my mouse, is the more customers you add, the bigger your profit is when you finally snap out the far end of this thing. Mm-hmm. But this generates an interesting problem for us, though, which is what would you do if you are presented as an investor with a business that's losing money? How are you going to know if this particular business will be eventually profitable as opposed to it could be a bad SaaS business? Mm-hmm. And so to understand that, you actually have to look at what we call unit economics. And the unit economic is really, what does it look like to have a single customer? Can I make more money from my customers than it costs me to acquire them? And for that, we have to look at these variables: CAC, cost to acquire a customer, and LTV, lifetime value of that customer. And to get to a viable business model, we've got to have LTV greater than CAC. But one of the things I find surprising is how few entrepreneurs really understand how big CAC is going to be. They generally just assume the product's so great, everybody's going to come to my website and find it, and they're going to just buy it. And they get this wrong. So this is much worse than you expect. So
I was just going to say, it reminds me of companies that, you know, all startups, you almost see they're always up and to the right, always have that, oh, we have huge growth. But I guess it can be deceiving, right? If you have a huge cost of customer acquisition, then, you know, your growth doesn't really matter.
Yes. And you know, another place where people get confused is that to calculate the lifetime value of the customer, see if I can find the formula for this here. So to calculate the lifetime value, you need to figure out the lifetime of the customer. And the way you do that is you take 1 divided by churn. Don't ask me precisely why the math works, because I'm not a mathematician to explain it to you. But you know, if you have a churn rate of 20% per year, your customers will last for 5 years. 1 divided by 0.2 equals 5. And that is, you know, you can do the math on 20%, and you're just this math turns out to be right here. So if you want to figure out how much money you're going to make from that, what you do is you say, how much money are they paying us per year? So let's say they're paying you $1,000 every year, and they're going to stick around for 5 years. If you take the 10,000 and you divide it by 0.2, you're going to get 5 times 10,000, which is effectively $50,000 lifetime value. But, and I hope this is not too much math too quickly here, if your gross margin is low because it costs you a lot to install and get this person onboarded, and you're having to use a lot of customer service to get them up and going, then you won't make as much money as that $10,000 per year. So you've actually got to multiply this by the gross margin. So let's say our gross margin is 50%. So instead of $10,000 of real money coming in, we've only got $5,000 of real money coming in. So our actual lifetime value in that situation is $25,000. So the reason why I bring this up here is that you do want to focus on gross margins as well as, because it does impact the right-hand side, the lifetime value part of this equation here as well. So hopefully that gives you a quick sense of things. And I will show you something super important here, which is really quite fascinating. Let me just find the right place in this. Yeah.
Do you think that traditional analysts of some of these high growth companies might be misvaluing or misreading the companies, like you said earlier, if they don't really understand some of these concepts, you know, like CAC and LTV and that kind of, do you think that some of these analysts working for financial companies are misreading these companies?
Well, about 10 years ago, when I first started writing about it, actually it was 2008, so it's 12 years ago when I first wrote about CAC and LTV, pretty much everybody was undervaluing them. And I remember going in to talk to my partners about HubSpot, and they were having a fit because we were losing, you know, 10 million a quarter in some of the quarters. And they were saying, my God, you know, this is a terrible business. You need to cut the slash the burn and expenses and whatever. And I was having to try and explain this to them. It was a new concept. Fortunately now, I think Saas is so common and popular that it's really beginning to become widely understood. Having said that, you know, a lot of people, I think, just know it at a very surface level, but don't really know the details underneath the hood of how it works here. And there is a clever thing that I want to talk to you about here, which is there's a difference between how quickly, so let me just see if I can find, so it's, to get your lifetime value right, remember how important churn was. If you could cut your churn from 20% to 10%, you would double your lifetime value of that customer. Instead of sticking around for 5 years, they would stick around for 10 years. But it turns out you are always going to have some amount of churn. A common amount of churn is somewhere between 10 and 20% per year. But there's something very clever you can do about that. And I want to talk about dollar renewal rate versus customer renewal rate here. So imagine a situation where we only have 2 customers. One of them signs up for $1,000 MRR is monthly recurring revenue, and the second one signs up for $5,000 recurring revenue. At the end of that year, the first customer churned, the one who spent a small amount of money, the 1K customer churned. So in that situation, we have 50% customer churn because we lost half of our customers, but we only lost 17% of our dollars. So this was not a big problem because we lost effectively a good customer here. But there's something interesting here. If customer 2 churn, we've got 83% dollar churn, but only 50% customer churn. So it's important to study those two metrics differently to recognize what's going on. But here's the really interesting thing. We lost the first customer, the small one, but we were also successful to expand the usage of the second customer. And now we've got negative churn. We went minus $16 in dollar churn, or we retained, instead of 100% of our revenue, we retained 116% of our dollar retention. And so companies that can do that, where your expansion revenue from your existing customers is greater than the revenue lost from your churning customers, that's a magical and very important thing that you have to get right in a SaaS business. If you don't have this right, our experience is that you can't really build a successful business over the long haul.
It's interesting. I think that concept's actually really similar to something that you might see in retail, where I don't know what the exact figure is, but the main profit from the customers only comes from the top 5% of customers. So they market a ton to those high paying customers. And that's what's really important to the retail customers. And the rest of them, it's great to generate traffic, but they really want to focus on those high paying customers. I feel like that's kind of a similar concept, but more in a SaaS sense.
Yes. Yeah, exactly right. Yeah. And we had this badly wrong. In the early days of HubSpot, we had a single price point of $500 per month, $6,000 per year for every single customer. And we were very proud of how lovely and simple our pricing was, but there was no chance of them expanding with that simple pricing. So what you have to do here is come up with what we call variable pricing axes, where you got a basic edition, and now you've got some things that you can upsell them on, maybe a pro edition. Or alternatively, you can have something where you check how many users they've got, or possibly another way of looking at things is how much, in the HubSpot's case, we would look at how many leads they had in their database, and that we thought was the best way to track the value that we were giving to them. But you want a metric that varies, that you can drive the pricing up, or the amount of money that you get up, the expansion revenue up in the customer over time there.
I have a question about the valuation. Sorry, David. Before when we were talking about how the gap versus your new SaaS pricing, the way you described your valuation isn't there a big risk of overvaluation of your company? Because even though they're recurring revenues, the churn might be a lot higher than anticipated, and you would lose a bunch of customers. Yes,
and if you understand the LTV and the CAC, and you make sure, I'm going to try to find the rules of that I have recommended, because they are helpful here. Hold on just 2 seconds. So originally, when I wrote this blog post back in 2008, which is a long time ago, admittedly, so what I did was I came up with some guidelines, and my guidelines were you needed at least 3 times greater LTV to CAC to have a successful SaaS business. And really the best ones are typically much more around like 5x and not 3x. But 3x I just put as a minimum. And it was a guess at that time, but it's been borne out major way. And back in 2008, it turns out it was very hard to raise money. So I recommended that people looked at 12 to 18 months to recover CAC. Nowadays, it's much easier to raise large amounts of capital. So you can go higher than that. And it's probably not uncommon for people to start at more like 24 months and then maybe work down to 20 months over time for the months to recover CAC. But what you will discover is that this doesn't affect profitability as much as it affects cash flow needed. So if the worse your months to recover CAC is, the more cash you're going to burn if you're fast. And it's pretty obvious why that's the case. So back to your question then, Nick, you were really asking, you might overvalue a company if they had high churn. And yes, you're dead right. But if you look at LTV and ask the question, what is the lifetime value of this company? That formula for LTV takes churn as a key input. So if you have high churn, you're going to have very low LTV. And therefore, so if you're studying companies out there, one of the things that you're going to want to try to understand is what is their LTV to CAC ratio, and that will give you a good sense of, is this likely to be long-term a profitable company, even though the GAAP metrics are terrible at this point in time and they're losing a lot of money.
Yeah.
Yeah, I think that is super important, the unit of economics, because I don't think a lot of people actually know those or study those. And I think that is a crucial way to value, especially companies nowadays, more and more are becoming SaaS companies. And I think that's a really important thing to know.
This screen for you guys.
Yeah, if anybody wants to learn more, David, like I said, has an amazing blog for entrepreneurs. So, definitely go check that out.
Yeah, and in particular, the place that I would present, would suggest people go to is this particular page. It's called Matrix Growth Academy. And really, I talk a lot about that 9-step model that we went through there. There's a lot of material here on the building of a sales team. There's the SaaS metrics, the CAC and LTV stuff that we talked about, the SaaS cash flow trough. And then things like what's the role of a CEO. So a single page there with a whole bunch of very small, short, broken down videos, like 10-minute videos on each of these little topics, might be a really helpful next step if people found this of any value to learn more.
Oh, it's perfect. I went through those videos and I definitely learned a lot. It's very inspiring.
Yeah, my pleasure. Really nice to meet both of you again. And actually, Nick, great to see you again. Nick, nice to meet you, Dane. And hopefully this is helpful, and it's always a pleasure to try and help younger entrepreneurs.